So welcome to day 2 of face-to-face class via Zoom. So those of you who were not here last week, we started looking at VAT, value added tax. We aren't going to go into detail, but just to recap the things that we have done last week, we said at the end of the discussion, you as a student, you should be able to explain what VAT is. You should be able to appreciate the characteristics of VAT, compute VAT, that is on input and on output, make out sales invoices including VAT, then develop skills in preparing VAT return. We went ahead to look at what VAT is, and then we said that it is that type of tax that is charged on goods and services. It is collected by registered businesses on behalf of the government, and at the end of the month is submitted to the government or the VAT authorities. We went ahead to look at the characteristics of VAT. Then we saw that it is a tax that is charged on consumption expenditure. It means that you will not pay VAT if you have not bought the goods on which VAT is charged. We also said that it is borne by the final consumer. Earlier on, we said VAT is charged right from the manufacturer, is pushed to the wholesaler. Wholesaler also push it to the retailer. Then the retailer finally push the entire tax to the consumer who come to buy the goods for use finally. So by the time the consumer buy the goods, the amount that he's paying for the goods is very huge because of the stages through which the VAT is charged. We look at the VAT is collected on multi-stage. We say it's collected by registered businesses and others. We went ahead and look at things that VAT registered businesses are supposed to do. We said they are supposed to pay VAT, they are supposed to charge VAT, and they are supposed to submit VAT to the that is the difference between the VAT they have charged and the VAT they have paid to the VAT registered office, that is VRA. We saw that there are two types of VAT that are calculated. We said we have input VAT and output VAT, where we said input VAT is that VAT which is charged on goods that are purchased, and then we say output VAT are those VATs that are charged on goods that are sold out. We went ahead and took an example on how to compute input VAT, and also took an example on how to compute output VAT. And we said once more, we said that input VAT, anytime you buy goods and you pay VAT on those goods, the type of VAT you have that is charged to you who is buying the good, we call it input VAT. So business organizations goes to buy goods for resale. When they buy the good, for instance, if it is the manufacturer if it is the wholesaler that is buying the goods from the manufacturer for resale, and VAT is charged on the goods that the wholesaler is buying, the wholesaler will consider the VAT that he had paid as input VAT. He also brings the goods to the premises of the business and then sell the goods to retailer. When he is selling the goods out to retailers, he is also expected to charge VAT. The VAT that he charges on the good that he sold out, we call that VAT output VAT. We say at the end of the period, we say the VAT that the wholesaler had charged on the goods sold out, he calculated all, and then also calculate the VAT that he had also paid whilst buying goods. Where the VAT that he had charged on goods sold exceeds the VAT that he paid out, the difference he submitted to the VAT authority. So we took an example which we have calculated. So we saw that wholesaler buy good from manufacturer 150 Ghana cedis plus VAT. What it means is that the wholesaler actually is paying more than the 150, because when we charge the VAT, we got 22 Ghana cedis, 50 pesos, which is the VAT element. And I asked my student, what was the amount that the wholesaler pays to the manufacturer? We saw that to know that amount is adding the VAT to the 150, which is the purchase price, to give us 172 Ghana cedis, 22 pesos. We also took a question that is on sales, and VAT on sales is an output VAT, which we have computed to look at what the solution is. We went ahead to look at how the VAT system works. That is the production and distribution. The VAT system work right from the producer through to the final consumer. We said that right from the manufacturer, when manufacturer produces goods and is selling it out, he charges VAT to the wholesaler. The wholesaler also buys and charges VAT and push it to the retailer. The retailer also buys goods and charges VAT, and then push it finally to the final consumer. So the demonstration here, we saw that a manufacturer sells raw beans. So supposing Perpetua is a manufacturer and then she's selling beans. The selling price of the beans is 10 Ghana cedis. Apart from that, she charges VAT of 5 Ghana cedis. If I am a wholesaler, supposing Ansel is a wholesaler, Ansel went to the Perpetua and buy the goods at 10 Ghana cedis, and then you also pay VAT of 5 cedis. So if you calculate the VAT, that is a 5% on the 10 Ghana cedis. We saw that the VAT will give us 50 pesos. So in the actual fact, Ansel will be paying 10 Ghana cedis, 50 pesos. So the second line, which is the distributor, who is the retailer, the Ansel, who is a wholesaler, also went ahead and sell to Makati. Makati, who is a retailer. And then he also charge, when he buys the good from Ansel, it will be that 50 pesos that perpetual charge, it will be pushed to Makati through Ansel. Ansel also is charging 5%, but Ansel selling price after buying the good from Perpetua, which costs him 10 cedis, 50 pesos, he is selling it at 15 Ghana cedis. He also said he's charging 5% VAT. When you calculate the 5% VAT on a 15 Ghana cedis, is getting 75 Ghana pesos. He then will remove the 50 pesos and then give to Perpetua. He is left with 25 pesos. But however, the entire 75 pesos, another retailer is there who is a coffee shop. He also sell the goods to coffee shop. The coffee shop, let's assume that Makati also sells to Emmanuel, and he's selling it to Emmanuel at 20 Ghana cedis. Meanwhile, there is already 75 Ghana cedis VAT there, right from the manufacturer, that is Perpetua, and then Ansel. He is now selling the good to Emmanuel at 20 Ghana cedis. And he's also saying that he's supposed to charge a VAT of 5%. When he charges the VAT 5%, he's actually getting a VAT of 1 Ghana cedis. And you realize that the final consumer now goes to buy that good at 20 Ghana cedis. So a good which is manufactured at 10 Ghana cedis, with review from various stages, VAT adding all through, the consumer now buy the goods at 20 Ghana cedis. So all the VAT that is charged from the manufacturer, which is Perpetua, through Answer, who is a retailer. Answer also sells to another retailer, which is Emmanuel, that is the coffee shop. He also charges, and then the consumer, which is the final consumer, let's assume I am the final consumer. I now go there to drink tea, and a cup of tea he's selling to me is 20 Ghana cedis. Then it means that I am paying the entire VAT that is charged. So we said that is how the VAT system works. Only one good that is manufactured, the government receives tax on the same good, that one good, on various stages into its coffers as a means of revenue. So this system satisfies the characteristics that VAT is a multi-stage. So when we go back to characteristics of VAT, we say one of them is that the third one is it is a multi-stage tax that is collected in little bit at various stages in the production and distribution chain. So that satisfies these characteristics, that it is a multi-stage tax because the manufacturer charges it, the wholesaler also charges it, the retailer charges it, and then the final consumer bears the entire VAT at the end of the period. Then we went ahead and saw how to prepare the VAT account. As an accountant, you need to prepare account. When we talk about account, we are talking about T account. So basically, what are the double entries that you need in opening the various accounts and record the transactions? And we saw earlier that VAT is computed in two ways. We say on input tax and then output VAT. Then we said that the input VAT is the VAT that is charged on purchases. So when you purchase goods as a business and you pay VAT on those goods, what are the accounts are you expected to open and record the transactions? We saw that purchases can be done in two ways. You can buy goods for cash. You can buy goods with cash, and you can also buy goods on credit. So, and then VAT may be charged on those goods. So we ask that if you buy goods or you purchase goods for resale and it is bought with cash and VAT is on it, what are the accounts are you expected to open? We also ask ourselves, if you buy goods and it's on credit, VAT is charged on that, what are the accounts? Yes, Webu, you raise your hand. Go ahead and unmute yourself and ask your question. Just unmute yourself and ask your question. Continue from where we have left off. So we were saying that we then went ahead and then look at how to prepare the VAT account. This is where we have looked at the double entries that are necessary, the account that we are expected to open to record the accounts that are necessary so far as VAT is concerned. We took it one by one. First of all, we said VAT is calculated in two areas. One on input VAT, and then second, output VAT. Then we have said that VAT is calculated on input. The input is when you buy goods for resale. So when VAT is charged on purchases, then the VAT that is charged on it, we call it input VAT. So we saw that when goods are purchased and VAT is charged on it, what are the double entries in recorded transactions? So we said when VAT is charged on goods purchased, that is input VAT, the account we are expected to open are one. We open VAT account and debit it with only the amount that is charged as the VAT. Two, we open purchases account and debit it with only the purchase price of the VAT. That is the total price of the goods minus the VAT. For instance, if you bought goods 70 Ghana cedis, and inclusive in these goods, 50 cedis is the purchase price and 20 cedis is the VAT, then if you are to record the transaction, take out the VAT element, which is the 20 cedis, and leave the purchase price itself. So when you take out the VAT, which is the 20 cedis, you open a VAT account and debit it with that. And then the 50 cedis, which is the actual purchase price, you debit it to the purchases account. The next account you open is, did you buy the goods with cash or check? Did you buy the goods on credit? Then, if it is with cash or check, certainly you are going to open cash book. That is either bank account or cash account. If that is the case, cash has gone out or you have used check to pay. So per the double entry, credit what goes out or the account that is given out. We then open the cash book and credit it with the total amount. That is the entire 70 Ghana cedis. Because when you bought the goods, pay the 50 and then the 70, the 20, which gave you the 70, the entire money was paid out, the 70. So you open a cash book and credit it with the entire amount. If it is on credit that you bought the goods, then you are not going to open cash book. Rather, you open creditors account and credit the entire value to the creditors account. So these are the accounts that you open when you are charging VAT on input VAT. Then we also look at the double entry on output VAT. That is VAT that is charged on sales, goods sold. We say when you are recording transaction regarding output VAT, you also open VAT. First, you open cash book, because when you sold the good, did you sell the good for cash? Meaning cash has come in, you receive cash. So you open the cash account or the bank account, or in simple terms, cash book, and debit the entire amount to the cash book. But if you sold the good on credit, then the one receiving the good here is a debtor. So you will be opening debtors account and debit the debtors account with the entire money. The next thing you do is you open sales account and credit the sales account with only the sales price, and then take the VAT element to the VAT account and credit it. For instance, if you sold goods and the value of the good you sold out is 90 Ghana cedis, and 10 cedis of that is VAT and the rest is the selling price, then it means that you are taking the 10 cedis and credit it to the VAT account, and taking the 80 cedis and crediting it to the sales account. So these were the double entry we have looked at in preparing VAT account. And we went ahead and said at the end of the period, you prepare what we call the VAT returns. In the VAT returns, you compare the output VAT with the input VAT. If the output VAT is more than, that is the VAT you have received on sales, it's more than the VAT you have paid whilst you were buying goods, that is the input VAT, then the difference you pay it to the VAT authorities. That is the Ghana Revenue Authority, the government. On the other hand, if you pay, certainly, then you'll be debiting VAT account and be crediting the cash book because you have paid out. On the other hand, if the input VAT is more than the output VAT, that is, if the VAT you have paid whilst you bought goods is more than the VAT you have charged on sales, then government will be refunding you with the amount that you have paid in excess. By so doing, when they pay you, you receive cash, you debit your cash book, and the VAT account will be credited. These were the double entry we looked at, and then we went ahead to look at an exercise to have understanding of the double entry. So we will take a new exercise. So was where we have ended last week. We took a question and then we prepared the account, and then to understand the double entry when it comes to VAT account. And then so quickly, let me just revise this with you. Well, the next question will be taking, certainly we will be getting a revision there, but then let me just revise it. So we took a question and we said Larama Shopping Mall, a VAT registered business, purchase goods on credit for 62,000 Ghana cedis. Goods purchased on credit. And the question went ahead to say, including VAT. Including VAT. So let's assume Perpetual went and bought a new mobile phone at 1,000 Ghana cedis, including VAT. And the VAT is 12 Ghana cedis. What it means is that the actual price of purchase price of the mobile phone is not 100 Ghana cedis. Why? Because the question is saying Perpetual bought mobile phone 1,000 Ghana cedis, including VAT. And the value of the VAT is 12 Ghana cedis. What it means is that the actual purchase price of the mobile phone is the 1,000 Ghana cedis minus the 12 Ghana cedis. So inclusive means both the purchase price and the VAT have been put together. Since Larama Shopping Mall, a registered business, purchase goods on credit 62 Ghana cedis, 62,000 Ghana cedis, including VAT. And we're told that the input VAT is 12 Ghana cedis. This is an input VAT, and we have looked at a double entry when it comes to input VAT. And the double entry we have said is to open purchases account, open VAT account, and then open creditors account because the goods was purchased on credit. We'll be opening 3 accounts. We go ahead and look at the second question. It said during the same period, the business sells goods for 150,000 Ghana cedis on credit, excluding VAT. The output VAT is 37,500, excluding VAT. It means that the selling price 150,000 does not include the VAT. It is an independent price, and then the VAT is also on its own. So the good that is sold out, actually, if you want to know the total selling price, is by adding the 150,000 to the 37,500. We are to open the necessary accounts to record the transactions. So we took the questions one by one. We look at the first one, when the goods was purchased, that is an input VAT. So we open 3 accounts. We open purchases account, and then we also open creditors account, and then we also open VAT account. Now the double entry to be made in them. When we look at the question, we said it purchased goods 62,000 including VAT, and the VAT value is 12,000. It means that for us to know the purchase price, we have to subtract the VAT. When we subtract the VAT, we get, that should be wrong. The actual figure should be 49,000. I think I took a wrong slide. 49,600, and debit it. And then the next is we credit the creditors account is supposed to be 49,600. Then the VAT value also go into the VAT account. That is by crediting the creditors account and debiting the VAT account. We then went ahead and looked at the second question, that is the sales. So we have to open the sales account and then debtors account since the good was sold on credit. And then we go ahead and open VAT account as well. The VAT account have been opened already. So there's no way we will be opening VAT account again. So when we open the sales account, we credit it with the sales price, which is the 150,000, and then we open the debtors account and debit it with the sales price, that is the 150,000. Then the VAT, the one receiving the good is the debtor. We will go ahead and debit the debtors account with the VAT value 37,500, and then go ahead and credit the VAT account with the 37,500 with the difference. You then pick the account one by one, balance them off, and then bring down balances. This was where we have ended last week. Today we'll be taking an exercise and then to further understand what we have looked at last week. So now back to today's lesson. I think this question also was taken last week. No, we'll continue from where we have left for last week. So today, let's look at this question. We are to prepare, so we say Medicine Limited sells 100,000 Ghana cedis of goods on credit, excluding VAT. It purchases vegetable goods and services for 70,500 Ghana cedis, including VAT. The company also bought a machine for 10,000 Ghana cedis, excluding VAT. And all VAT is expected to be charged at 15%. We are required to calculate the amount of VAT to the nearest 1 Ghana cedis. That is the output VAT to the nearest 1 Ghana cedis and input VAT to the nearest 1 Ghana cedis. What it means is that the value should be round up. So, solution. Then the next is to prepare the VAT account itself. So let's look at the question closely and see if we'll be able to understand how we go about preparing the output VAT and then the input VAT. So it is your duty as a student to go through the question and see on what do we charge the output VAT. So per the question, can somebody tell me or help us to understand on what are we going to charge the output VAT? Yes, we have 2 transactions, 3 transactions in there. Which of them will output VAT be charged on? And then we'll look at which of them will input VAT be charged on. If you know the answer, just raise your hand and respond. I asked a question. My question is per the question that we have on the board, on the screen. On which of these transactions will output VAT be charged? And on which of these transactions will input VAT be charged? Yes, Perpetua. Unmute yourself and speak. Just unmute yourself. If you do not unmute yourself, we cannot hear you. Unmute your voice and speak. Yes, I saw your hand. Okay, now you can speak.
Okay, the output
I cannot hear you.
VAT is going to be
Virtual, I can't hear you.
output VAT.
Are you using
The
earpiece?
output VAT.
If
Yes.
you are not using earpiece, then it will be difficult for me to hear you. If you are not using earpiece, then I cannot hear you whilst you speak. So if you are not using earpiece, it will be difficult for me to hear you. Answer, do you have an answer to my question? McCarthy, you are not focused in a class. You are looking outside. Do you have an answer to my question? All right. Then let's go ahead. So we'll calculate on input VAT A. We have to, yes, answer. I have brought the solution already, so shut up. So on output VAT is charged on goods sold. Output VAT is charged on sales. So if you look through the question, we have only one transaction that is on sale. That is selling 100,000 Ghana cedis worth of goods on credits, excluding VAT. That is the only transaction that is on sales. So if you want to calculate output VAT, we will be doing the output VAT on only that transaction. So our output VAT in this case is multiplying the 15% by the 100,000. That will give us 15,000 Ghana cedis. Then move to B to calculate the input VAT. The input VAT is charged on purchases. In this question, we have two transactions concerning purchases. So we have to compute the input VAT on all of them. The first one is purchase goods and services worth 70,000 Ghana cedis 500. If you charge, and then we were told that this is, look at it, it purchases vegetable goods and purchases for 70,000 Ghana cedis, including VAT. Including VAT. It means that VAT is inclusive in this. To determine that, we will have to take 15% out of 100 and then 15. Why is it 115? 115 because the VAT is inclusive. It's inclusive. It means that the VAT is added. The VAT is added to the purchase price, and that gives us the 70,500. So it means that the purchase price originally is 100%. Are we all right? And then the VAT 15% is being added. So if you are adding 50% to the 100%, that will be giving 115. I am taking it again. The reason why we are multiplying the 70,500 by 15 over 115 is that we were told that the vegetable good which were purchased for 70,500 include VAT. It means that there is a value of VAT inside the 70,500, which we have to determine. And that value is 15%. What this means is that in the 70,000, there is an original value which is for the purchase price, and there is also a value that is for the VAT. So we are assuming that the purchase price is 100%, and then the VAT is 15%. So if we are adding the 15% to the purchase price, which is the 100%, that will be giving us 115. So the total 70,500 there is giving 115 in all. So if you are determining 15% of it, we take the 15% out. So 15% out of the 115 give us 9,196 Ghana cedis, which is the VAT. So if we are asked to determine the purchase price, then we'll have to deduct the 9,196 from the 70,500 to get the purchase. So we're trying to calculate the input VAT on the 70,000. So to get the input VAT on the 70,000, that was what I was saying. We multiply the 15 over 115 by the 70,000. The reason is 150 being the denominator is because the VAT is inclusive in the value. And now will give us 9,196. There is another transaction concerning purchases. They said the company also bought a machine for 10,000, excluding VAT. This transaction, VAT is not inclusive. So we just charge the 15% on the 10,000 direct because the VAT is not inclusive. The selling price is on its own. And sorry, the purchase price is on its own. Before they are charging VAT of 15%, we just multiply. Doing so will give us 1,500. So the total input VAT will give us adding the 9,196 Ghana cedis to the 1,500 Ghana cedis. So the total input VAT here will be giving us 10,696. That is the input VAT. C is asking us to prepare the VAT account. C is asking us to prepare VAT account. Don't forget, in the VAT account, before we bring the solution, when we go back, we saw that on input VAT, which is purchases, when we are preparing VAT account, we open VAT account and debit it. You remember? We open VAT account and debit it. Whilst the purchase value also be debited. So what happens here is that, and if it is output VAT, we open VAT account and credit it. So C, we are to prepare VAT account. All we do, we haven't opened a VAT account, we bring the input VAT, which is on purchases, 10,696. Debit it. Then the output VAT, which is 15,000, which is on sales, is also credited. Next is to find the difference. The difference is at the debit side. That is balance carried down, giving us 4,304 Ghana cedis. We total both sides. The total for both sides, 15,000. We close the accounts and bring down the balance, which is the 4,304. So that is the input VAT, the output VAT, and the VAT account. Please, do we understand what we have just done? Because the next thing is I'll be giving you a question to try your hands on whilst I wait for you to finish quickly and present your solution. If you understand, raise your hand. Let me know if you understand what we have done, because the next question is for you. Without